Have you ever wondered how to buy property 20% below market value? Well, if you have, you're not alone. I've nearly 20 years experience in the real estate market, and I ask myself that question all the time. I'm sure you've read about it, you've heard about it, I'm sure you've watched YouTube videos on it, explaining that you make your money when you buy your property, and the best way to buy property is at a 20% below market value. I understand the first point. It is important to buy well, and you do make your money when you buy the property. However, the second point I do struggle with in terms of continuously buying properties that are 20% below the market value, and how do you continuously find those type of properties. In this video, I'm going to explain my understanding of what market value is. I'm going to quickly discuss some of the narrative around buying 20% below market value, as well as giving you some helpful tips in terms of how you can actually increase your property value by 10, 20, or even 50% or more in terms of using good asset management strategies. For those of you who don't know me, my name is Shane Fleming. I'm a chartered property surveyor. I have over 17 years experience working in commercial and residential real estate. I have a degree in property economics. My base is in Dublin, and I'm currently learning about the New York market. First off, let's define what market value is. And I'm boiling this definition down to the simplest terms, but it's generally a definition that's well accepted worldwide. And that is, the market value is defined by what a willing purchaser will pay a willing seller, where both are acting rationally, where they're both not connected with each other, and the property has been actively marketed. All over the world, professional bodies, property professional bodies from the Royal Institute of Chartered Surveyors, the SCSI in Ireland, as well as most accountancy practices around the world will use that definition or very similar to that definition. And it's something that I've used to define market value for my career as well. So the market value is what a willing purchaser will pay a willing seller, where they're both acting rationally and the property has been actively marketed. That doesn't mean that a buyer can't purchase a property at the market value and assume that the property is actually worth more. Worth and value are two different things. Worth is a personal perception of what something is worth, where value is what the market will actually pay for it. So someone can easily go and buy a property and automatically say it's worth more, but that's their personal view. The market value is what the actual property will trade for on the open market. Before I get into explaining how you can increase your property value by 10, 20, or even 50% or more, I'd love a bit of support. Your support is so welcome, so please give this video a thumbs up. And if you are interested in growing your knowledge in real estate, please make sure to subscribe to the channel as well. So there are a few ways that you can actually acquire property below the market value. One of the most common ways is where there's a very highly motivated seller who needs to sell quickly for whatever reason, and you are a cash buyer and you can come in quickly without having to deal with banks and get that contract signed and completed quickly. Generally speaking, in those cases, you may get a discount of 5, 10% or more. Another route might be approaching a property owner who doesn't quite understand how much the value of their property is, agreeing terms with them and completing that deal. Generally speaking, in Ireland, that doesn't happen a huge amount, because when that deal lands on their solicitor's desk, the solicitor may raise some red flags, and also if there's a mortgage on that property, the bank may raise some red flags as well. And in that case, the actual seller is not acting rationally because they're not aware of the full value of the property, and perhaps the buyer is not being over ethical in terms of how they're approaching that transaction. So I'm going to give you a little bit of a story of how that actually did happen once in Ireland. I'm aware of it happening once in Ireland. Obviously, it may have happened other times, but in terms of an agent actually doing it, it happened about 12 years ago. Don't give out to agents, they're not all like that. There is always one or two bad eggs, but it happened about 12 years ago in the Midlands in Ireland, where an agent was going to sell a house or sell a family farm for a family, and he went and purchased that property via a separate company. However, the seller at the time wasn't aware that the agent was purchasing it themselves through a separate company. The agent went on a short time later and sold the family farm for a much larger profit. The son of the family found out about this, sued the agent, won. The agent had to pay over the difference in terms of what they had sold the property for versus what they'd bought the property for. So the agent lost all their profit and had to pay damages. The agent lost their license as well. And I think, I may be wrong in this, but I think there definitely may have been a jail sentence as well. I don't believe this kind of stuff happens a huge amount in Ireland. Obviously there is a risk to it, but I don't think it happens a huge amount. And I don't think there is a huge amount of people out there who are taking advantage of people in those scenarios. There are ways to buy property at market value and increase that value by 20% or more quickly. And I believe that's where the real opportunities lie in terms of investing in property. I believe most investors, when they're actually referring to buying a property at 20% below value, what they're actually talking about is that there's an opportunity to increase the value quickly by 20% or more. Granted, there are some investors out there who will be referring to buying property below market value and taking advantage of people who need to sell quickly. And if you are a cash purchaser, perhaps there is opportunities like that out there. However, to find those opportunities, you need a large network, I'd say, of solicitors, agents and accountants who may feed leads into you, where they may have clients that need to sell quickly. Given our legal structures in Ireland in terms of how long it actually takes a sale to go through from a legal point of view, a few weeks of marketing is not going to really hurt anyone who is desperate to sell either. However, I believe the greatest opportunities for long-term strategies is actually trying to improve the value through different mechanisms, i.e. refurbishment, changing the legal title, getting planning permission, or changing lease structures. And when you can combine a handful of those, that's where your greatest opportunities lie. An example of improving the title perhaps is something like that there is no proper planning documents in place, or even that the title deeds are lost. Perhaps in a lot of these cases, banks aren't actually willing to lend, but if you're a cash purchaser, you can go in and buy the property, improve the title or replace the title. It may take you a year or two, but once you have actually done that, you've automatically increased the value of the property. When you're purchasing the property, even if that is on the open market, you are buying it at the market price, because the market value for that property will be based on the fact that there is a title defect. So while you are seeing that there's an opportunity to increase value, you are still buying it at the market price because the market is reflecting the fact that there is a defect there. Another great way to improve the value quickly in properties is around the lease if it's an investment property. Perhaps you need to change the lease in some way, or remove a tenant that's in arrears and replace them with a tenant that is paying and on good lease terms. That will automatically improve the value of the property. Refurbishment is another great way to improve the value of a property. One great example that sticks out in my head all the time when this comes up is I looked at 2 apartments a few years ago in Milltown. One sold for $425,000. It had a new kitchen and bathroom refurb done, probably at a cost of about $25,000. 2 doors down, same apartment, same layout, sold for $310,000. The only difference was that didn't have a refurb done, and the kitchen and bathroom were there since probably the 1990s. The property sold for their market value. One sold for its market value because there was interest in it, because it was ready to move in at $425,000. The other one sold at its market value because there was work to be done at $310,000. However, with a refurb of 25 grand or so, you could have improved the value of that property that sold for $310,000. So therefore, there's an opportunity there within the refurb to increase the value by 20%. Some of the best examples of trying to improve the property value through good asset management are actually on the commercial side. One good example of this, where an investor changed multiple things about the property to improve the value, is the former ACC Bank, which is the now WeWork on the Canal in Dublin. Property was bought while ACC were moving. At the time, council planning rules had changed where you could get additional height on the building. The new investors applied for planning permission for 2 additional floors. They got planning permission for those additional floors, and they refurbed the old office block. They put WeWork in at a prime rent on a long-term lease, and sold the property on. They bought the property originally in 2017 for 45 million. 2 years later, in 2019, after they completed the refurb, got planning permission for 2 additional floors and leased the property on a long-term lease, they sold it for 145 million. That's just an example of how someone can increase the value of the property through good asset management. Another good example of that is the Salesforce and Microsoft building out in Sandyford. Investors came in and bought it for roughly around 100 million. They then went on and re-geared a number of the leases that were in the buildings, and they did a small bit of a refurb to the atrium and the reception. In about a year after they bought it, they sold it for 180 million. That just goes to show that a few small changes in terms of the leasing structure can have a huge impact on the value of the property. The same thing can be done for smaller units as well. You can find vacant units if you know an interested tenant who is looking in particular areas or needs a certain requirement from a gym, retail unit, etc. If you know they're looking and you have an idea what rent they might be able to pay, you can go and find properties that might suit them, agree terms on those units, purchase the unit while it's still vacant, and the minute you close that sale, you can put a lease in place with your new tenant, automatically increasing the value of that property. On the residential side, refurbs can actually increase the value twofold. One, a refurb will increase the value of the property, and two, you'll increase the cash flow that comes from that property from a rental perspective as well. There are lots of other examples like this, and while I believe there are opportunities to buy some properties under market value, perhaps 5, 10 or 20% below market value, those deals are very hard to find, and a long-term strategy is probably best to see how you can actually increase the value of a property. So look for opportunities where you can actually increase the value by 10, 20, 50% or more, and I think good asset management strategies will work out better for you in the long term. If you are interested in buying or selling, please reach out. I will leave contact details below. If you've watched this video all the way through to here, please give it a thumbs up. If you are interested in growing your real estate knowledge, don't forget to subscribe to the channel. And as always, thanks for watching.